Okay, I think we'll make a start. Good afternoon, everyone, or good morning, depending on where you're sitting. Welcome to today's webinar. My name is Matthew Huxham. I'm a consultant at CPI Energy Finance. We're a team of analysts based in London and San Francisco, whose mission is to accelerate the low carbon transition around the world, focusing on improving energy policy, regulation, and investment structures. I'm part of a team that is quite diverse, and we've got a range of backgrounds, including time spent in government, strategy consulting, investment banking, rating agencies, and utilities. We've invited you to this webinar to hear the results of our latest study on renewable energy investment vehicles, the results of which we published at the beginning of last month. We published two papers, first one in a series called Mobilizing Low-Cost Institutional Investment in Renewable Energy. The first one was called Major Barriers and the Solutions to Overcome Them. And the second one that we're going to be focusing on today, structuring the Clean Energy Investment Trust. These papers developed with the support of the Rockefeller Foundation, were the final two of three charting a new financing approach that we think could transform infrastructure financing over the long term and lower the cost of renewable energy in the shorter term. Some of you will already be familiar with the general concept of the Clean Energy Investment Trust, or CEIT, through our outreach program. And so during this call, we're going to explore a few aspects of our analysis that didn't necessarily make it into the executive summary of those reports, but have been major talking points in our subsequent discussions with investors. So what are we going to cover today? We're going to set out first why we think a new approach for financing clean energy projects is needed. We're going to set out why we think our approach is better suited to the requirements of institutional investors than existing offerings. Apparently you can't see my screen, so let me try. Sorry, technical issues. Has just disappeared. Leslie, can you try and sorry folks, we should be back on the treadmill in a minute or so. Okay, so as I was saying, why do we need a new approach for financing clean energy projects? We're going to spend a bit of time explaining why we think this approach is better suited to the requirements of institutional investors than what's currently available on the market. We'll then spend quite a bit of time talking about how the instrument works and focus on how we're structuring it to ensure that it has an investment grade like risk profile. We'll then give an introduction to two other important investment opportunities that are related to the CEIT. We will and then tell you a little bit about what we're planning to do with this next, and in particular in the short term, and how you guys on the phone and others potentially can help us out. The presentation is going to last about 30 to 40 minutes, so we'll have plenty of time for questions at the end, around 20 minutes. If anything springs to mind as you're going through this, please do submit your question in the chat box on the bottom right of the screen. So our presenters are going to be David Nelson, who is the Executive Director of CPI Energy Finance based in London, and Uday Varadarajan, the principal who led the analysis in San Francisco. And with that, I'm going to hand over to David Nelson to tell you a little bit about how this work started.
Thank you, Matthew. Can you hear me?
Yeah.
Good. Just a couple words on CPI to begin with. CPI is a think tank and strategic and financial advisory group dedicated to finding and implementing solutions to the suite of economic, financial, and policy issues surrounding climate change. The way we distinguish ourselves from a number of advocacy groups in this space is the advocacy groups generally are looking to generate political will to overcome some of the barriers that might be facing a climate change challenge. CPI, on the other hand, what we're trying to do is make the transitions as efficient as possible, looking at the long-term state that will lead to an efficient industry that will reduce the cost and political will needed to make that transition. So we're very much focusing on the policy and systems that reduce the cost related to a transition. And in that vein, our focus is on land use, energy, and finance. One of the things that we've heard since the inception of CPI 8 years ago now from policymakers is that, well, if institutional investors could just put their money on the table, all the problems would be solved. Meanwhile, with our extensive conversations with institutional investors and other investors, we've always heard we've got plenty of money to invest if the policymakers would just get the policy right. So beginning 5-6 years ago, we set out unpeeling that issue. Beginning with extensive interviews with investors and asset managers, consultants, peeling apart the actual strategy, the strategic asset allocation models that the investors were using, understanding how different classes of investors had fit into this equation. And what we have found is, yes, indeed, there is plenty of finance, but what really is the issue here is a combination of cost and capital and risk. That is, the systems that are often in place impose more risk than is needed. And what that does in turn is raises the cost of capital and therefore the cost of energy sometimes that comes out to a level that is higher than policymakers are willing to pay. In the particular instance we're talking about here, we believe that once you get the Clean Energy Investment Trust we're talking about in place, in many, many circumstances, the energy will be significantly cheaper than the conventional alternatives. And so in some ways, you are eliminating a share of the political will needed. But to get there, what you need to do is you need to get the right investment vehicles with the right risks that match the appropriate investors in each of these cases. You need to be overcoming things like liquidity barriers that prevent some institutions from going in, transaction costs or project size, which means that maybe only the largest investors can afford the team, or the high management fees that reduce the economics of this and transfer the value here. But to each of these issues, all of these issues, there are both policy solutions and finance solutions. And the CEIT that we're talking about today and the component investments around it are one of the most promising ideas we have in that space. It is based on the premise that renewable power under long-term contract from wind or solar has relatively predictable energy flows, and with a fixed price produces something that's essentially a bond-like stream. It is the natural investor shouldn't really be energy players like investor-owned utilities, but rather institutional investors who need specifically this type of match to the long-term liabilities to have the cash flows guaranteed to meet the pension funds, annuities, and insurance policies that need to be paid out in the coming years. The U.S. yieldcos and others have seen this. And in fact, the yieldco craze that came off a couple of years ago was based on this storyline and this premise that the natural owners need a different type of investment vehicle to own this. But that vehicle drifted away by including growth of asset pipelines. A lot of the valuation was based on the fact that there was going to be a growing market to acquire new assets, these yieldcos would purchase these new assets. And what ended up happening there is that growth pipeline itself is risky, and it added the risk back to the to these portfolios, to these renewable assets, in ways that meant that they were now equity vehicles, that they no longer matched in a low-risk nature the cash flows that the institutional investors were seeking in the first place. So in our evaluation and development of the Clean Energy Investment Trust, we have gone back to basics. We've gone back to the original kernel of that idea, but seen what we could do by looking at various structuring mechanisms to optimize this, to meet the needs not just of the institutional investors, but writ large the financial community, to achieve the lowest cost finance and achieve the policy objectives of low cost renewable energy there. So when you take that all together, what the institutional investors will need at the very highest level is a fixed portfolio of contracted assets. And this is now on slide 3 that's in front of you. We're looking at an optimum structure. We'll probably have a list of 5 to 10 large operating contracted wind or solar assets with investment grade counterparties. You will have those assets. At the exception of this CEIT, those will be the assets in place. These will neither be bought nor sold for the duration. And what you actually have is this as your annuity, the cash flows that come out of these projects through the life of the investment. So that is, there's close-end and they have no growth, no buying and selling allowed to eliminate that risk. We're looking to pay out as close as we can to 100% of free cash flows each and every year, with some adjustments that we'll be talking about in a couple of minutes. But to make sure that you have very reliable cash flows, so that institutional investors can rely upon those cash flows. This needs to be low risk. It needs to have a financial structure that reduces the risk, and we need to have low fees. Together, that is what our analysis has shown will produce the optimal financing for a clean energy investment trust. But what I'd like to do is to peel the onion one bit more by introducing all of you to Uday Varadarajan, who will take us through a bit more of the detail.
So thank you so much, David. And so I'm going to try to discuss in a bit more detail how we are able to achieve a vehicle that can address the needs that David just laid out. And to do that, we're going to start by taking a look at a typical renewable energy project and looking at the different phases and cash flows in such a project. And in particular, looking at the risk and rewards in each time phase of a project. And for a project, usually there are essentially 3 such distinct time phases. You've got development and construction, which is relatively high risk, and some of the problems that you'll encounter are delays, cost overruns. These are very market correlated problems. Depending on where the market is, you may or may not get a project done, etc. This is a very different product than the next phase, where especially if you've got an operating asset that has long-term contracts in place, there are relatively low risks over a fairly long duration of expected cash flows. And the main risks that you encounter here have to do with the output and performance of the project, O&M costs, resource risks, both volatility and long-term estimation risks, and then counterparty risks from anybody who's on the other side of the contracts you've got in place. And then finally, after this contract period is over, you've got another relatively higher risk phase, which is associated with potential cash flows available after the contracted period is over. And this is a period where you might think about repowering an asset, or you might just continue, depending on the prevailing market prices, to sell the output of the project in power markets. So given these 3 different time phases, our approach to trying to understand how to get a good liability hedging product out of this is to try to think about ways that we can maximize, in particular, the proportion of a debt or debt-like capital investment as a percentage of the overall value in this portfolio. And to do that, we found it helpful to unbundle these cash flows in these 3 phases into 4 different investment products with different risk profiles. And how do we get from 3 to 4? Well, we still have the development and construction financing, which really is essentially equity with short-term debt. And it's a fairly well understood and relatively efficient process of raising development and construction finance, at least in developed world economies with operating capital markets. And so we're not very concerned so much with that first phase. However, in the operating and tail, we think that's where there's some value to be had. And it's really maximizing what we think is this second piece of the investment product, which is really the Clean Energy Investment Trust. It's the low-cost, long-term, debt-like cash flows that are very predictable that we think need to be optimized. But in the operating life of the asset, as we mentioned earlier, there are some risks, and many of those idiosyncratic risks associated with a particular project or portfolio of projects are not necessarily suitable for a bond-like investment. And so these additional cash flows we refer to as residual or surplus cash flows, and that's the third investment product that we're talking about here. And then finally, as we discussed earlier, there are cash flows after the contracted period of the asset, the tail or post-contract cash flows and repowering value that are yet another source of value that is of interest here. Now, we think that the Clean Energy Investment Trust itself is the piece that ought to be suitable for a long-term investor. However, the other two pieces are relatively much more risky, the residual cash flows and the tail post-contract cash flows, and are not likely to be suitable for liability hedging. So the key, we think, to achieving apologize. Let me see. Can you see my screen? I seem to be unable to see. Ah, there it is. Can you all see slide 6? Apologies.
Yes.
You can. Okay. For whatever reason, I can't. Okay. Give me a second. Oh, so the key, we believe, to ultimately bringing down the capital costs from the CEIT, as we mentioned earlier, is to maximize the size of the cash flows with that investment grade or bond-like risk profile. And the idea here is that if investors do indeed see this to be an investment grade-like product, it should attract long-term investors who are interested in holding these cash flows over a longer period of time. And if over time, as that product becomes established and, for example, included in any indices, we expect that the return available would end up being something like a small premium over a BBB rated bond. So the question then becomes, how do we actually get to an investment grade like risk profile for this chunk of the cash flows, and how do we maximize the size of that investment grade like risk profile? Well, first, let's just note that at the end of the day, these are contracted assets, and we require that the contracts be with investment grade counterparties. And so if that's all we had to worry about and the cash flows were effectively guaranteed through those contracts, getting to investment grade would be straightforward. Of course, that's not the case, and it's not sufficient to simply ensure that the counterparties are investment grade. And indeed, there are additional risks that are significant and important in this case, and investors that we spoke to made clear to us that with a portfolio of assets, these risks are what traditionally have made renewable investments, particularly for early investors, more of an equity play. And so what we did is we spent quite a bit of time trying to understand the nature and magnitude of the main additional risks, and we focused in particular on a portfolio of wind assets, and we used historical data from FERC, EIA, as well as consultants like DNVGL, looking in particular at the North American wind fleet. And what we found is that much as the many investors we'd spoken to had suggested, there were some significant risks, even in contracted wind assets, that early investors perhaps in the sector may not have really bargained for when they were thinking about the risk involved in a contracted asset. And the most material of these were associated with resource estimation error and unanticipated capital needs. So what I mean by that, and here I've got some results on this graph that show exactly how big of a deal these errors are. So what I mean by that is based on, the first one is based on publicly available DNVGL data. What we found is that roughly 1 in 100 wind plants in North America underperformed their pre-construction resource estimates over their lifetime by around 20%. So effectively, they produced 20% less in generation over their lifetimes than was expected based on pre-construction estimates prior to COD. And so this is, by the way, not just the possibility that you have annual variation, which is of course important, but generally less important than this question of whether the asset actually is going to give you the energy over its lifetime that you expect. And while the annual variation can be dealt with all the usual project finance mechanisms, the possibility that you may have pieces of your portfolio that systematically underperform is definitely more problematic. The other thing that we heard about that is a significant risk is the possibility that you'll have an unanticipated capital investment, particularly in the first couple of years, to address some big maintenance CapEx need early on or at some point in the life of the asset, well before the contracted period is over. And to assess this risk, we used data from FERC, fairly unique data in the United States that people we don't believe have appropriately mined, to look at the fleet of assets owned by regulated U.S. utilities that have to report on their capital investments. This is about 5 to 6 gigawatts of wind. And what we saw from that data set is that, again, the extreme cases in that about 1 in 100 wind assets, you see that you've had a need for about up to 15% of their initial investment in unanticipated maintenance CapEx needs, usually in the first couple of years. And so these are significant risks that need to be managed if we're to get to anything that looks like a bond-like vehicle. And so how do you do this? So what we found is, first of all, it's important to note that the first thing we want to do is really quantify and think about what level of mitigation we need to get to go from such a significant risk down to the level of risk that we might want to achieve for investment grade. Now, historically, I think the way this has been dealt with is to put a fairly high used project debt and put in a fairly high debt service coverage ratio to account for these idiosyncratic risks. And what we wanted to do is to ask if there was a different approach that could be possible. And what we found is that achieving an investment grade risk profile could be possible using a package of alternative structuring tools. And what we mean by achieving an investment grade level of risk profile that mitigates those risks is to really look and ask what kind of methodology credit rating agencies use to look at debt-like instruments. Now, of course, they don't look at equity instruments, but we're trying to create a vehicle here, a clean energy investment trust that is debt-like in nature, and so we use that as a guide. And so we used historical data from Moody's as well as their methodology. So looking at the expected losses and in a given rating level and their methodology for looking at power project finance. And what we did is, based on looking at that data, what we found is that the threshold to really achieve an investment grade-like risk is to try to get these idiosyncratic risks associated with a particular project portfolio, those that can't be associated with some simple counterparty credit rate risk, down to a level where a CEIT can achieve its targeted cash flows in 99 out of 100 cases in a simulation of those project risks. And so what we show here is some analysis that we did based on that full data set of FERC, EIA, and DNVL data of a hypothetical portfolio of North American wind projects and asked, how do you get from the level of risk that we see in a single asset using structuring mechanisms down to that level of risk where a CEIT can achieve its cash flows, 99 out of 100 cases, given all of these potential project risks. And what we found is that you needed a combination of different structuring elements to make this happen. Obviously, you need some portfolio diversification, so you can't just do this with one asset. You need a diverse portfolio of relatively uncorrelated assets. You also need a conservative resource estimate, so you can't give out exactly 100% of all the cash. You need to hold back a little bit as to what you give in the CEIT. You need cash reserves. You need a full-service O&M contract to address the O&M needs. You need a purchase price adjustment. But interestingly enough, you also need tools that go beyond that. And this is where we connect back to the other two investment vehicles, which in particular, there is a role to be played by the tail cash flows as well as by an investor to hold on to the residual cash flows that we'll discuss in a bit. And to motivate that, let's first start by taking a look at what kind of risk reduction is possible through diversification alone. And to do that, we're going to start by asking how far you can get by using diversification for a particular model of a CEIT. And what we find is that transaction costs effectively, as well as general diminishing returns associated with portfolio diversification, give you a limit as to how much you can really do with a larger portfolio of assets. And what we find is that the sweet spot is somewhere between 5 to 8 independent assets. If you're below that, then you've got risks that you are unable to diversify away and you're forced to be more conservative. And if you go above that, you find that transaction costs could outweigh further diversification benefits. So diversification certainly plays an important role in making a CEIT possible. However, that's not all that's required, as we saw in the previous graph, to get us down to an investment grade-like risk. And the interesting feature here, the structuring element that we believe is somewhat novel here, is that there's an important role to be played in the sale of the residual or surplus cash flows during the operating life of the asset, as well as the tail investments. And these investments actually can play an important role in producing an investment grade-like CEIT. And I've got here a graph that tries to kind of outline how these investments end up playing a necessary role in enabling a CEIT that can achieve an investment grade-like risk. And the critical issue here is that the tail and surplus investor by selling effectively these additional cash flows close to COD, you can both get additional resources that can help offset some of the cost of structuring early on in the life of the asset, particularly the presence of a reserve, and the surplus investor is essentially absorbing the additional risk during the contracted life of the asset associated with some of the volatility of annual cash flows. And while the tail investor has a role ultimately in guaranteeing the return of the reserve. So how does this work? So first of all, and who would, in principle, and I think there's several questions here of interest. One is, how does this work? How do the additional investments work? And who are the right investors to take on these risks? So let's turn next to the residual cash flows. So these residual cash flows during the contracted life of the asset, in principle, could be of interest to investors looking to take on essentially these annual and relatively volatile resource risks and the asset risks during the life of the asset. We think of these investors potentially as long-term equity-like investors looking for relatively higher returns. So traders, developers, independent power producers, retailers, and they're looking for the upside. cash flows, rather than necessarily just a simple tail guarantee or guaranteed cash flows during the life of the asset. These investors, at the end of the day, in order to get these investors into the vehicle, we've got to deal with a trade-off between making the investment effectively large enough to be of interest, while still making sure that these surplus cash flows don't end up making the CEIT too small to really have the full impact that we're talking about. So how does this work? So effectively, these surplus investors are taking additional cash flows that are not promised to the CEIT. Well, the CEIT if the CEIT is getting nearly 100% of the cash flows, then we have to be taking a slightly more conservative view on the target cash flows to the CEIT in order to generate any surplus value to begin with. And indeed, that's the critical variable here that's controlling the size of the surplus value, how conservative we are in our estimates for the target for the CEIT. And the trade-off that you can see in this graph is, with a fixed number of assets, the more conservative you are in sizing the CEIT, the larger the value in the surplus or residual investor. But the larger that value eventually, the less value you have in the CEIT itself, and the lower the impact on savings in cost of electricity. On the other hand, on the other side, if you make the surplus investment too small, you're not going to be able to find someone to take on that risk. And if you distribute too much of that cash to the CEIT, it gets too risky. And again, you get an issue with needing a larger reserve or other mechanisms to result in the same cost savings. And so we find that the sweet spot is to have a conservatism for the CEIT that roughly is equivalent to requiring that the CEIT be targeted on cash flows that are expected at levels that are expected to be exceeded by 75 to 95% of annual cash flows. So let's move on next to the tail. We believe that the tail could be of interest both to long-term equity investors, financial investors, as well as potentially, and this is where we think things get quite interesting, to companies, to corporates in the energy sector. Again, these are long-term cash flows. The difficulty here is that these are cash flows that are expected somewhere between 20 and 30 years in the future, and we need very patient capital. Investors who are really looking to put in place a very long-term hedge against energy prices, for example, or some institutions that are looking to take a position on the future of growth in this space. O&M contractors may again be a natural fit for this, along with OEMs and developers who have natural long-term interests in this space. And the important point here, as we're looking at the tail period, is that the tail period really has essentially two distinct sources of significant value. One is the revenues that are expected from future sales, potentially at market prices after the life of the contract. And then the second is the option value for repowering the asset. Now, however, the challenge with the tail is, of course, this is fairly far into the future. And in order to make the tail work for a CEIT structure, the tail actually needs to play an important role in absorbing the risks associated with the return of the CEIT cash reserve. So ultimately, in order to achieve an investment-grade-like risk level for the CEIT cash flows, including the return of the reserve, which is partially funded by the CEIT investors, we need to guarantee the return of that reserve. And if you look at the size of the tail cash flows over time, these tail cash flows are increasing in value relatively rapidly. And the size of the potential value of these tail cash flows very rapidly exceeds the amount needed to finance return of the reserve. So this is a fairly natural guarantee, but in this structure it is important that access to the tail is gated upon a willingness to guarantee the full return of the seed reserve. And so what does that mean in terms of sizing of each of these individual pieces and for the structure and its performance? And so for the next slide, what I'm going to kind of take you through is a graph that's a little busy, but effectively what we find is, again, the size of this reserve influences the amount of value that's ultimately transferred to the tail investors. And what we find is that looking at a number of different cases with different levels, again, of conservatism in the sizing of the seed and asking what is the maximum reserve guarantee liability as a function of tail value, that is really trying to figure out what the trying to assess the extent to which the guarantee that's being provided by the tail impairs the tail value. What we find is that somewhere between, again, P75 to 90 seats, there is a sweet spot where the maximum reserve guarantee liability, with at least somewhere between 5 to 8 assets, results in a reserve guarantee that is a relatively manageable, smaller fraction of the tail value, somewhere between 10 and 20%. And indeed, the net result of this, on the next slide, is that we found what looks to be a relatively sweet spot in the structuring of a seat. So if you're able to manage to pull together a seat with about somewhere between 5 and 10 uncorrelated assets, and with reserves that fall below about 20% of tail value, we found that from our simulations that you could effectively reduce the cost of wind energy in this case by between 15 and 17% through the use of a seat structure that eventually results in a lower cost of capital relative to prevalent wind financing costs, and to do so in a way that results in risk for the seed investor that are below that investment grade threshold, and appropriately sized surplus and tail investment vehicles that should be attractive on a risk-adjusted basis for their investors. And so, to summarize, we find that an investment grade seat, even if it is, and this is one of the issues, we've imagined an investment grade seat as something that would be potentially a legally an equity-like instrument with a target that is met with investment grade-like risk. We find that such a seat could help reduce the cost of energy from onshore wind farms by between 15 and 17%. We expect that the seat overall could have a lower rate of return than current buyers of operating clean energy projects, because we believe it would have a higher proportion of debt like low-cost capital, and indeed we're talking somewhere upwards beyond 90% of the operating cash flows would flow to the seat. And despite this effective higher leverage, we find, based on our simulations and analysis, that the seat can have a similar risk profile to investment-grade bonds. And this is really because of that more targeted allocation of risks to other parties, contracts to O&M providers, as well as potential through diversification, but in particular through allocation of certain critical risks during the operating life of the asset to the surplus and tail investments through the reserve and through a more conservative resource estimate for the purposes of seed targeting. So as a result, we find that these surplus and tail investors may be a preferred way for utilities, developers, O&M contractors, and OEMs, other parties, to potentially retain stakes in the project without necessarily having to have a large ownership position in fairly less attractive, from their point of view, long-term contracted cash flows, but rather allowing them to deploy their scarce capital in portions of the cash flows that are more suitable from a risk-reward point of view to their investors' interests and needs. Now, of course, the optimal seat structure, we've suggested that there's a region where we can find an optimal seat structure, but there's quite a bit of play there, and the optimal seat structure will ultimately vary depending both on the technology and market investor group, and there's room for different approaches to the seat. Finally, just in terms of what our hope is with the seat, we believe that there is a real opportunity here, and over the next 6 months or so, we expect that the seat concept will move into an implementation phase. And with that, that is essentially the end of what I had prepared. Thank you so much for taking the time to listen.
Thanks very much, Uday.
And I'll hand it back over to Pat.
Thanks very much, Uday. I just want to give David Nelson a chance to add any thoughts, if he has any, before we move to questions.
No, I think that was a good summary, and I'm ready and open for any questions.
Okay, so just a quick reminder to everyone on the call, you can, if you have any questions, you can submit them through the chat box in the bottom right of the screen. We will be making the slides and the recording available at some point in the next week or so after this. While those are coming in, one quick point that has been raised by a number of parties in our in our discussions following the publication of this paper, perhaps a point of clarification about whether this instrument, the Clean Energy Investment Trust, is equity or debt, and if it's and why don't we just do it like a project finance but with higher leverage. I think the key as to and there may be certain investors in certain regions who prefer this to be legally structured as debt. But in the ideal scenario, we would see this as structured as equity, and this is important because, unlike in a typical project finance structure, if you have the majority low-cost capital provider in control of the structuring, and then parceling out certain risks to the relevant parties, there is, much less of a chance of adding back those unnecessary risks required to boost returns, whether they are growth-related risks or financial-related risks, which is a typical structure that lots of project finance and private equity type structures have considered. So we do have one question from Stephen Bailey, and he asks, does our analysis consider the possibility of curtailment risk? We have considered this explicitly, but I will let Uday answer that in a little more detail.
Apologies. So curtailment risk is something that we've looked at in a bit more detail, and the analysis that we did assumed that that curtailment risk was going to be managed effectively through the structuring of the contracts involved, that there would need to be in any assets that were suitable for the seat some mitigation of curtailment risk through contractual means, particularly curtailment risk that was effectively economic curtailment. We think technical curtailment risk is something that can be managed, but economic curtailment associated with negative pricing or any kind of tariff issues, impact on a tariff, is something that just would be a gating factor for whether or not a given asset would be acceptable or suitable for a seat. And so indeed, and the rationale here is that the market risk that you'd be subjecting an asset to if you had unexposed and unmitigated curtailment risk would not enable you to create a structure that ultimately could possibly yield an investment grade like bond. So indeed, that is an important issue, and one that we did consider in the paper, but we view that as something that you need to have addressed in your portfolio before you try to make a seat.
I think one I'd just like to add to that. Most of the analysis that we did in relation to resource estimation risk and maintenance capex, use that data set that Uday mentioned, focused on certain amount of historic data. Now, clearly, with curtailment and in particular economic curtailment, then the picture could and most likely will change extremely quickly, depending on which market we're in and what the regulations are in relation to curtailment. So, for example, we did some research last year into the situation in Germany where we saw if with no significant change in regulation, negative pricing and the impact on investment could rapidly shoot up in the 2020s. So really good point. I can see that okay, so we have one more question from Brian O'Connell. And the question is, a diversified portfolio is likely to have different contract lengths. How will this impact your analysis? Perhaps, Uday, do you want to take that?
Sure, and indeed, I think there could be both opportunities and some challenges associated with having assets with multiple potential durations available. And we might find, for example, there may be many different ways of dealing with this. There may be seats where the focus is on assets that are perhaps that only have maybe 10 years remaining left in their contract lives. And one of the opportunities may be that for a seat like this, the repowering rights become a much more valuable and interesting opportunity. And there may be modifications to the structure that you might want to think about, or modifications to how you approach the seat for a vehicle that's dominated by shorter-term assets. However, we believe at the end of the day, and further, I think even for any seat, the choice of a portfolio and the choice of durations for a given seat can be tailor-made for the particular institutions that are involved and ultimately want to hold this. You may find institutions that are looking for particular durations of assets, and you have an opportunity with assets of different duration to select a portfolio that can better suit and be matched to the duration needs of a given investor as well. Now, there are challenges with modified duration like this, for example, or for an asset or a portfolio with varying contract lengths, particularly in defining the tail investment and in the timing of tail cash flows and reserve sizing, as well as in the guarantee. So one needs to be more careful about the specific contracts one has, or the specific conditions of different investors and their position, particularly if you have tails that start at different periods, substantially different periods. One could also see an opportunity for a portfolio of assets with different durations that, for example, for a tail investor, there may be value that is realized earlier in the life of the seat, perhaps even as early as year 10 through year 20, to give a more gradual and less long duration, or less to provide cash flows earlier in the life of a tail investment than would otherwise be done with this assumed fixed, largely similar contracted period seat that we've been considering as our ideal.
And I'd just like to add, I mean, we've had quite a bit of debate internally about what this tail investment might look like, and indeed whether this tail investment singular might in fact be tail investments plural, and whether for example, each asset might result in its own tail investment. And you could easily imagine that happening if the tail investor is in fact the original developer of a given asset. The other point to mention, of course, maybe it's an obvious one, but just to hammer home the point about this being a closed portfolio at the start, you'll know. Even a portfolio with assets of lots of different contract lengths, you will know at the start what your expected cash flows and therefore expected returns to CEIT investors are going to be, and and that isn't changed by the mix of contract lengths. Okay, any further questions? If there are not, then we will move towards closing. I just want to remind you all again, we'll be sending through the slides, and you will have access to the recording at some other point in the not too distant future. For those of you who are interested in digging into this analysis any further, in the next week or so we'll be publishing a technical appendix to the structuring paper, as well as a whole load of the detail around the data set that we use to support the risk analysis. And I think that's important, because our aim with this work really is to get the ideas out there to as broad a group of people as possible, and we hope that people from a whole range of different perspectives will be able to use that data to maybe think about how this kind of structure could benefit them. But in the meantime, we will be taking this forward and working with interested parties, and we're happy to help anyone who has a serious interest in implementing this. If there are any follow-up questions, we'd love to hear from you. We will send you all of our emails through the portal as well. So, without further ado, thank you very much for joining, and wish you a good afternoon or morning.